Yo guys, welcome to Walsham Weekly. This week I'm speaking with quite a good investor. His name is Alex. He is a university investor. I think he's in his final year, and I'm basically speaking to him about investing, how to invest, why to invest, what kind of investing I think is good. So basically I found that I think in this episode there's so much good information from a very experienced investor who definitely knows a lot about the stock market. But I think for some people, it might be slightly too much. Like a lot of people won't know anything about this. So I'm just doing this little section before just to sort of teach about investing, how to start investing, blah, 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 all that kind of stuff. So first off, I'd just like to cover how you can save money and then invest. So there's a lot of good places online where you can learn to save money. But for myself, I think the number one thing you should do if you want to save money to then invest is figure out what your weekly, bi-weekly and monthly income is, and then pick 10%. For myself, since back when I was 15, 16, it was very, very easy for me to save money. I did not have many expenses at all, but my main expenses were like, I didn't really have any. It was just sort of me going out with my friends and doing stuff like that. So really, I could potentially invest something like 75%. But say if you have expenses, you have rent, all that, blah, blah, blah. I reckon it is very doable for most people. Not all people, for some people. But if you have a fixed income, say you make $500 a month and you spend, say you make $500 a week and you have to spend $400. Then maybe you could go for $20 or $30 that you just, $20, $30, $40 or $50 that you just spend because, you can be too strict on yourself if you want to. But I think it's more reasonable to just start off slow. So then you just start off with $50 a week and just put that into a savings account. The thing you have to do is you have to get another bank account set up. You cannot use the same bank account that you use for your normal, you can't just use your checking account. You have to go get a dedicated savings account. Some banks give you an increased interest rate, which is great because it just all adds to it. In general, you're not going to be getting much from interest if you're putting in $50. And for myself, I got a bank account that penalized me when I actually took money out, but it gave me, if I didn't take money out, then it gives me a higher interest rate, which is quite amazing. Personally, I go for something like that, if that's available to you, and just save whatever, $50, or if you're a student, just save a certain percentage. And the very thing that you must do is, one, you must get a new bank account that hopefully penalizes you for taking that money out, but not too heavily, obviously. Or you can get another. The other thing you must do is you must take the money out the moment you get paid. Because if you're not doing that, then there could be major issues with just, if you're not just taking the money out the moment you get paid, then you could have, if you don't take the money out instantly, then you could be at risk of just being completely frivolous and just spending your money and being like, oh, blah, 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 I don't need to save, or just forgetting to save. Or some people, some banks you can, if your income is very, very steady and it's not like on and off some weeks, you can just set it and forget it. You make an automatic payment to that bank account the day you get paid each week, or even the day after. I'd prefer it like on the day, or maybe the day after, just because you don't know what time it's going to come in. And I would only really do that if your bank account is very steady. What I do is I just set a reminder on my phone that tells me, okay, you get paid on this day, so let's just send all the money there now. And yeah, so basically that's when you put in your $50, your $100, your percentage, whatever, just as much as you can put in. And like, you've got to realize, like, this stuff adds up very, very quick. Like, I think just from 1 year, if you're putting in $50, it's like 2.6. Yeah, that's 2.6 grand the thing you've got to realize with saving is you still have that money. That money has not gone anywhere, but now you have this money in an account and you can actually make good use of it. And that's where compound interest comes into play. So for myself, I saved around $2,000, and this was just doing a normal, kid's job, and I wasn't even that good at saving. Like I know people who saved a lot more percentage wise. I was only really saving hard for like maybe a year and a half, and I managed to save up like, I was only really saving for about a year, and then I managed to make a 13% return in about 6-7 months, and then that was like $200 or something. But the thing is, you've got to consider that is just one trade. But like, basically I'm going to explain compound interest right now. So compound interest is basically, if you earn $200 of interest or gains from an investment, those gains then go towards making more gains. So instead of, you have $2,000 working for you essentially, if you invest it, but you now have $2,200 if you make a successful investment. So basically that money builds on itself. If I use a basic compound interest calculator, on my blog I've calculated a few different scenarios of compound interest. So if I have an initial deposit of $1,000 and a weekly deposit of $20, that's just $20 a week at a monthly interest of 7%, which is the average return of the stock market. So if you just invest in an index fund, this is generally what you're going to be getting over the long term. Maybe worse, maybe better, but usually if you are an active investor, it's quite easy to get a lot better than this. So if your initial deposit is just $1,000, your regular deposits after 5 years are $5,200. This is just from $20 a week. The total interest you've earned is $1,183. That is $7,383. So you've earned $1,000 of interest off just over $6,000 of investment. And this is from an initial deposit of $1,000 and a weekly deposit of $20. 20 years. This is if you do this for 20 years, investing only $20 at the average return of 7%, it ends up at $24,000. That is the interest. $24,000 of interest and $46,000 total. The total amount that you have invested is 21 grand. No, just under 22 grand. Yeah, basically, I recommend you go check out my blog post and just look at this and see the amazing thing that can happen with this. And basically compound interest and how, I guess, the magic. After something like, after around 20 years, really your interest is, in most cases, your interest is just as much as your deposit. And that's only at 7%. So really compound interest is a very powerful thing. And that just shows that what you're saving now and the tiny amount of, because you just see the number 7%, that doesn't seem like much. But in 20 years, you've doubled your money. And that's just 7% from $20 a week with an initial deposit of $1,000. And you can take out the initial deposit, whatever. You're still going to start $1,000 after 1 year from just the initial deposit. So it's quite easy to do. Just start. That's the main thing. Just start. So a few of the other terms that I thought I'd sort of explain. So investment, that is basically you put your money, you can't touch your money. You put it in, say, the stock market, or you put it in, you buy some bonds, or you leave it in a bank account. That is an investment, which is something like a long-term investment from like 1 year or 6 months, or it's very long. It's reasonably long-term. Really, I think everyone should be investing. What you are investing is your capital. So yeah, that's basically capital. Capital is money. The money that you have to invest, that is your capital. And dividends are basically sort of interest you earn for owning a stock. Say for Spark, you get an extremely high extremely high dividend rate. You get a dividend rate of like 5%. It's quite insane. So they basically, if you have $1,000, or if you have $100 worth of Spark, they will give you, if you have $100 worth of Spark shares, they will give you $5. It's like, it says on the app that it's 7%, but I don't believe that. I've looked around and I see it's more like 5%. And so that is 5% interest you're making per year when you hold Spark shares. So basically, I thought I should also explain shares. basically, stock is a company. So the stock of Spark is Spark stock, basically, and it is basically a piece of the company. So you own a very tiny piece of the company. Say one share of Spark right now is valued at just under $3. Okay, like one share of Spark is valued at just under $4. So if you own one share of Spark and Spark is worth $400, then you own 1% of Spark. So that is basically what a share is. So basically, if you're investing in, really, you will mainly, if you're only investing something like $1,000 or $2,000, I recommend you start no less than at 1,000. This is just due to just transaction fees, which for my company that I invest through, which is ANZ Securities, it's very easy to set up an account. It takes a while and you've got to get accepted, blah, blah, blah. You just need to give them all your details. And usually you can do it through your bank if you live in New Zealand, or I know, there's a good American one. There's tons of American ones that are quite good. I don't know about UK. I think there's got to be good ones through your bank as well. I think for the majority of companies, you can just do it through your bank. But for my bank, I think that the fee does go up if you go over $5,000. So once I start investing over $5,000, the fee goes up at like some tiny percentage. Like right now, I pay to invest $2,000, I pay around $30. So it's quite cheap. So, but you've got to take that into account. Like and this is the difference between investing and I mean, it's prospecting. No, it's investing and speculating. Basically, speculating is more along what I do, or what I attempt to do. Basically, but the thing with investing is don't invest in companies that you like unless you genuinely like them as a company, not their products. Maybe investing in their product isn't a horrible idea, but say, since I like Spark, and if I invest in them now, when they are hitting massive highs every day, just because they're hitting highs every day, which can be seen as a good thing, it's not particularly a good thing. A good thing is more like I just bought a stock because it was low, but I know that it's going to be valued in the future. Like Warren Buffett always says, if you think the stock is still going to have massive value in 10 years, then buy it. So if you know, like if you're very comfortable, the stock market closes tomorrow, if you're comfortable buying that stock and you know that industry will still be booming in 10 years, then I think it's a good idea to buy that stock. And well, he does, and I get a lot of my stuff from him. But yeah. And basically when he's talking about commodities, he is talking about a commodity is also like coffee or copper or oil or something like that. Reasonably simple. So yeah, I hope I've covered most of the basic stuff. So yeah, I'm probably going to get into the interview now. So yeah, enjoy the interview. Hopefully I didn't ramble too much.
I'm going to show you how great I am.
Everything around you that you call life was made up by people that were no smarter than
Everybody has time. Stop watching lost.
I love what I do, and that's why I'm doing what I love.
Hey guys, welcome to the Wonky Wall Shammy Show. I am here with a student investor, Alex, who has been trading for a while. And so how did you start this whole journey of trading and investing and financial freedom?
Right, nice to meet you. Basically, I grew up in Bangkok, in Thailand, and obviously there, when I was 14, 15, getting a job is not a possibility because people there, the minimum wage is like 50 cents. So getting a job there is not a possibility. So I had to look at another way to try and make some money. And so I searched online, and I found this thing called binary options trading. Yeah. And what it turned out to be was just basically pure gambling, but I gave it a go. I made some money, and then I lost most of it, but it got me hooked, making that money. So then I was looking at what else I could do to make money, and I found currency trading, which is basically buying and selling different currencies and taking different positions to try and make money, and that got me really interested. I read a lot of books, watched a lot of not TV shows, like just shows about it. Read all the great classics about investing and stuff. And 4 years later, now I'm trading, finally starting to make some returns, which is good to see.
What sort of like books would you recommend, like things like that? Is there certain things you'd recommend to stay away from when learning? Yeah,
definitely stay away from the. You get all these people online who say, this is the great pattern, and if you pay $1,000, we'll give you this trading strategy, and you're guaranteed to make like 90% return or something. That's not realistic at all. The best hedge fund managers right now, they're averaging about 6 or 7% return a year, right? So the people that say they make 100% return every year, they're full of shit. Sorry. So basically, the classics are like Snowball by the Warren Buffett, The Reminiscences of a Stock Operator, that's a really good one. What else is there? There's Flash Boys. It's a book I'm currently reading. It's just about sort of the new realm of trading that we're entering, like high frequency and all that sort of stuff. But obviously all the old greats as well.
What do you mean by high frequency? Do you mean like, because I know there's different styles of trading. Would you say that's more that everyone is moving towards a more month period as people? I was reading I think it was the Intelligent Investor, and they were saying that.
Oh, that's another good book, yeah.
Yeah, like they're saying that everyone used to sort of trade and think in years, but now people are starting to move more towards months. Would you agree with that?
Yeah, no, definitely. What high frequency trading is it's algorithms, so it's computers. So it's not actually people that are trading. It's these computers that buy and sell within microseconds. So the whole dynamic of Wall Street and all the big investment banks and stuff is shifting towards more heavily based on just automated trading. So I think it's now 52% of all of the orders on the New York Stock Exchange are performed by algorithms, not actual humans behind the investment. And so those guys trade within milliseconds, buy and sell and close their positions and within milliseconds. Investors, which are different to traders, investors are more people who look towards long-term trading, so a couple months, 2 years. And that's probably what I would suggest to the people that are listening who are students and whatnot, is looking at value investing rather than trading itself.
Do you have any tips for value investing and that sort of investing?
Yeah, okay, so definitely, search up value investing, find out what it is. It's basically about, looking at companies that are undervalued, whatnot, and, spending the money that you're not afraid to lose. That's another key. The most important part about investing is, it doesn't matter whether you're right or wrong. Most of the time, what really matters is how you manage your risk. So, for example, the classic saying, don't put all your eggs in one basket. I mean, that holds true. So value investing really just, just do your research. Look at companies. Look at if you can understand their business model and you think it sounds good. And don't follow the hype. Like there's a lot of people I know actually bought Bitcoin. I don't know if you know about that.
I was looking into that. Do you think that's
it's definitely a go. I myself have some Ethereum, which is like the opposite to Bitcoin. But I mean, I found that I bought that stuff a month and a half ago, back when it was at like 80. It hit 450. Right now it's down at 280 or something. There's a crash. What happened was a lot of people, they bought into the hype. So they bought in when it was already like nearly at the top. And then they got burned when it crashed on the way down. And the reason it crashed is because all those speculators, those people that aren't used to investing, got freaked out when they started to see it crash, and that's why it crashed so much. But so don't go into the hype. Look at basic companies on the NZX 50 or something, or the ASX 200, Australian and New Zealand Stock Exchange, because they're way more accessible. You can open a brokerage account with ANZ or those banks.
Do you think there's, because you touched a little bit on sort of portfolio diversity before. Do you think you can be too diverse, or do you think you should focus on certain stocks?
I think people can get a little bit too caught up in trying to like have a completely, what we call a neutral portfolio where no matter whether the market's going up or down, they're making money. Right, and that first off, that takes a lot of work and a lot of research, and some of the big hedge funds are failing at doing that, and these guys have been in the business for 20-30 years. So I think and you also need a lot of capital, because you need to spread it across a lot of different assets, right? But most ordinary student investors don't have the capital to do that, and they don't have the expertise, and they probably just spend all their money in brokerage fees.
Yeah.
You know, so stick to, you know, maybe 5 or 10 stocks max. Really, it depends how much money you have. Or if we're talking about value investing, currencies. Value investing is not really a thing. Currencies, it's more about short-term trading or long-term trading. I mean, 6 months is like kind of the max. You don't buy a currency because you think it's going to constantly. It's not the same as stocks. Yeah.
With currency investing, would you say that's a lot more volatile? And would you say, like, when it comes to people using events to make money, sort of like with, for instance, an obvious one. What do you call it? Brexit. Would you say student investors and new investors should stay away from stuff like that?
I think yes. For example, look, value investing's never orientated around events trading. It's because those are just single events that cause volatility, and obviously volatility begets for volatility, and there's heightened risk in the volatilities because you can't. A lot of people in Brexit went into the position thinking there's no way UK is going to leave. England's going to leave. Yeah. European Union, but they did. So a lot of people got burned in that with the volatility. I think it dropped 8% or something, the currency, the pound. I didn't trade it personally, but although I am a trader, so I do trade some events. But no, with value investing, you don't really want to look to events to make money. You want to sort of obviously manage look at the earnings reports, because those will affect stocks and equities. So you want to look at those, but don't actively going, I'm going to go long this stock because I think they're going to have an earnings report, a good earnings report. You don't know that. You can do as much research as you want, but you don't know that for sure, unless you're like inside the business, and none of us are.
When because from what I know, the main principles of value investing is like know the company and learn about the company to sort of buy it. Is there a way you personally go about and reading about a company and learning about the company to then go and invest?
Yeah, so a really good way is looking at their annual reports. So they publish all their financials and where they see their business going. So what you really want to do when you appraise a business is obviously you look at the financial stuff. So you could look into stuff called like a DCF. It's called a discounted cash flow analysis. Look at all the other ratios like EBITDA or PE ratios. So they're like financial ratios basically to show the financial health of the business. You can search those up all online. Investopedia does a huge on all of those ratios. So if you want to learn about that. Other thing is, a lot of people like to approach investing from a purely, I'd call it micro. They look at the internals of the business and just the financials and stuff, and that's a great way to look at it. But I also like to look at the industry as a whole, the macro environment. So definitely do an industry analysis. How they doing relative to their competitors, or how is the interest rates going right now? Because that affects most businesses. The interest rates. Particularly in New Zealand, or what government policies are coming out. What is risk sentiment in the market? Are people, are they risk averse, or are they willing to take on extra risk? This all affects how a company is going to perform in the long term.
And do you think, because if everyone is feeling as though there's a lot of risk right now, do you think that it's a good idea to, not always a good idea, but an interesting idea to go the opposite way and not follow the crowd? Do you think there's value in that, or do you think
for sure? I mean, right now we see the S&P 500, which is the American Equity Index. It's one of the best barometers for risk in the global market, because if the S&P 500 is going down, you can bet the New Zealand 50 and other emerging markets and stuff are following, right? The more risk, we call it further out in the yield curve kind of assets. Yeah. So the S&P 500 right now has been hitting new time highs virtually every day, and the volatility index, which is the VIX, is kind of a measure of risk insurance. So when people think that there's a risky event and the S&P 500 might drop, they buy VIX. Yeah. And obviously, but the VIX has reached below 10 recently, but it's done it, I believe, 6 times in the past month, when it had only done it 3 other times in history since back to 1980 or something.
So,
Right. So
what does that mean?
what does that mean? Is it basically means that there's a lot of complacency in the market. Investors are not realizing what the risk is. I mean, equities are at all-time highs, right?
Yeah.
But they're not having any insurance against their equities dropping. They believe that there's this huge bull market that it's going to keep rising and rising and rising. But all equities and economies are cyclical.
Yeah.
The business cycle, whatnot, and there hasn't been a correction in the market since 2008, right? So we're long overdue for a correction, but investors aren't showing this risk. So for me personally, what I'm trying to say is, to answer your question, you do want to look against the crowd. Not always. You don't always want to be contrarian because you might just end up not making money. I mean, if I'd always thought for the past 3 years that there was going to be a recession soon, then I wouldn't have made any money in those 3 years, right?
Yeah.
But for me personally, right now, I'm keeping 50% of my portfolio that I would be investing in equities in cash because I want to wait for that correction to buy it when they're cheap. And I mean, I just recently heard Warren Buffett has 1.5 billion for Berkshire Hathaway in cash right now, ready to buy out stocks when they drop. So if that's not a telltale sign, then I don't know what is.
So do you definitely think there's like a huge risk? Do you think it's a bad time to start now, or?
No, it's not a bad time to start now. I just think be aware that you are very likely buying in at a very high price right now.
Yeah.
Just because these indicators are, at all-time highs and all-time lows in the VIX, right, doesn't mean there will be a recession soon. It just means that the risk reward essentially is heightened.
Yeah.
Right? The higher we go and the lower people are, they're not realizing what profound risk is in the market right now. Then when it does hit, it's going to be more severe than before. So you know what? I totally wouldn't suggest putting all your money in stocks right now. They might keep rising for another year or two. It happens. There's outliers in what happens, but be aware that you are buying in at a very high price right now, and the risk reward is not great.
Is that just because it's been going on for so long? Like,
it
hasn't happened since nearly
open up an S&P 500 chart right now and just click on the daily, and you should see it goes straight up.
It's like a massive. Because do you think when people do you think people don't realize when there is continuously like highs every day, and even if they know about corrections and all that, do you think people don't realize that there will be there's going to be one eventually?
Well, I think most of the people in the market, right? Most of the capital in the market doesn't come from investors like you and me. It comes from big pension funds and big hedge funds, and these guys are looking at it and going, right, we know there's a lot of risk right now, but we have to make a return, and because it's so hard to make returns right now because the savings rate in Europe is negative, and it's like 2% here in New Zealand, right? It's incredibly low. So people are starved for yield essentially, so they have to look to these riskier and riskier assets to try and promise, the 8 or 10% yield that they say they try and make every year. Yeah. Right. So they're going out and they're reaching for a higher yield, and by doing this, they know that they're taking on more risk, but it's just something they have to do, and they believe they're confident enough to manage it, right? Yeah. When it does, they're gonna sell at the top. That's what they think. And some of them will, and some of them won't, right? Yeah. Some of them will get burned. So, I mean, the people that don't, I'm not saying to student investors that would be listening to this, go out and conduct 5 hours of market research every day. Yeah. That's not plausible. So I think, equities do present a really good passive form of investment where you just put your money and you slowly add to it, and in 10 years you see your money grow. So if I was looking at specific advice, look to 5 or 10 stocks, but also indexes are a great way to diversify your money. So the NZX 50, there's smart shares in New Zealand, which provide a really good way to buy and sell these funds, and just put your money in, and within 10 years, It's more than likely there might be a correction, but a correction only lasts for 1 or 2 years, and then it starts to recover.
So with like index funds and funds like that, would you say? So I was looking into that the other day, and a lot of the funds seem to be labeled as like growth funds. Do you think you should stay away from that, or?
No, those are fine. They just they're looking at generating a return, right? They track the big indexes, and because basically what an index is, it's just a basket of all the top 50 companies in New Zealand, right? The top 50 largest market cap companies there in the NZX 50. So, I mean, your risk is diversified because it's unlikely that all 50 of them, will be doing poorly. I mean, that only happens in a recession. So, yeah.
Do you think it's good? Index funds are good because they're in a way they minimize risk, but they still give you adequate return. Yeah,
exactly. I mean, you're not going to get the hyperbolic returns that you would if you invested in like riskier assets, like I don't know, penny stocks or Bitcoin. But you're going to get most of the time consistent returns. Like I think on average the S&P 500 nets an 8% return per annum, right? And you compare that to the savings rate right now, and that's 2%. Essentially, savings rate is deemed the risk-free rate, but so because obviously there's risk in the S&P 500 and indexes, but I mean, you want to be actively investing as young as you can. Right? I'm not saying you have to have a lot of money. You really don't need to have a lot of money to start, but just by starting, you're setting yourself up well for quite a lot of years. You got compound interest and whatnot.
Would you say, because personally for myself, I just started by just saving up $20 every week and then just eventually getting enough money that I thought it was reasonable to go and invest?
Yeah.
I mean, just randomly.
You can start with $100. It doesn't matter. Like, just put that money in. I'm not sure on the commissions of smart shares and whatnot, so maybe save up a bit more than that. But passive investing is a good way to go for sure. Saving in the bank, yes, is all right way to go. You obviously want some of your money always in cash, right? Don't put all your money in investments because they're not liquid and they take a while to take out. And whereas cash is liquid, right? Yeah.
Sweet ass. I think we'll probably cap it off there. Thank you guys very much for listening. Thank you very much for coming on.
No problem.
That's a very intelligent, thoughtful conversation. Don't get to have good ones like that every day.
Yo guys, I'm going to put this after the fact. Well, you guys probably know that, but after listening to that conversation, I realized that there's a few things that I should give my opinion on because, basically with the whole, things that I should sort of clarify, when it comes to the correction or like the crash, I think that's like a very, very, very real thing. Like I believe it's probably going to happen. Like when I say things like this, I feel like it's sort of like saying, oh yeah, the world's going to blow up. Like the world's not going to blow up, but I feel like we are like twice as high as we were before when it comes to the S&P 500. Like last 2 times we were just about at the same level, but now we are so much higher than that, and we just keep every single index grows every day. Like every day something's going up. Like there's days that we stall, but like on a weekly average there's not many down weeks, and that's kind of scary, to be honest. Like that's why I'm trying to keep most of my money in cash, but I feel like there are other investments that you can do. For myself, I'm mainly keeping the majority of the money in cash, and just I have maybe 20-30% invested, and it's just in an investment that I know even if there is a crash, I'm fine with just leaving it there and just letting it stay how it is and not really having an issue with it. So one thing is you've got to be willing to really lose that money. Like especially like if you invest in an index fund, then I don't think you need to be willing to lose it. I just think that you need to be willing to not touch it for at least 2 years. Like that's probably not going to be how it is, but if you're investing now, like in 2017, which I think everyone should be, but I think they should be doing it with extreme caution. Like I was thinking about investing in Westpac and ANZ because they went down because they got all this bad press and blah blah blah. All these Australian banks had the South Australian government going after them, and that made their stock prices drop a bit. yeah, basically I thought, hey, well, this is a bit of good event investing, but then one thing is the event might actually have devalued the stock. The second thing is with this, if there is a crash, they're going to crash so much. Those when they're directly involved in the mortgages, that's why a lot of the crashes have happened. It's just because of loaning, because everyone's just giving out money, and then eventually there's a correction, and then no one wants to give out money, so that takes so much of their business away, and they just have to readapt their whole business and change everything, and that's never really good for. Yeah, I just don't think it's a good place to invest. So the thing I've invested in now is, even if there is a crash, I still think people are going to spend money there, so it's not going to crash to the ground, for one. And for two, I think because I think a bull market is the rising market and a bear market is the crashing market. So when it's rising again, after maybe 1 or 2 years, which is the general length of a correction, then I think it'll be much better to invest in something like anything really. Like you could invest in even in an index fund, and you just leave it there for a few years. You just set $1,000 in a random stock that you know is going to go up. Like for myself, one of my first investment was Auckland International Airport. The thing that I realized, well, my father, he sort of pushed me towards Auckland International Airport over a few other stocks, just because no matter what happens to Auckland Airport, we're going to have it in the future. Like there's not many situations where we're not going to have Auckland Airport. There's always going to be a way where we do have an airport. Like there's not many events or catastrophic things. Even in a financial crisis, it would crash, yes, but like I don't think the amount of flights happening is going to change too much. Like people aren't going to be going on holidays as much, but the main thing that it will affect is just people and businesses' bottom lines. Like it's people just spend a lot less, and then eventually that'll be gone in 2 years, and then everything will be going up again, and everyone will be happy and blah blah blah. Like eventually it'll just go back to normal. So yeah, another reason is why I'm cautious of this correction is because there's so much stuff going on today. But like people have always said that, like the whole time I've been around on this planet, people have always said, oh, it's such a crazy time right now. But like people always say that, but I don't mean to be very all political, but I think like with Trump and with the North Korea thing and Syria, like blah blah blah, there's all these things that could just set off an economy and just make it snap. Like in 2001 and 2008, it wasn't really current events like that, but certainly that we're on the brink of something, I reckon. And I don't think we're on the brink, but I think if something does pop off, then that could definitely set off a financial crisis, or it could be very, very good, because I know war times are very, very good for financial booms. But for instance, say just what happened in miniature form with ANZ and Westpac. Those are New Zealand banks for people that aren't familiar. Those banks both just crashed. They not crashed, but they lost a significant amount. And basically, to my understanding, I don't know too much about the issue, but basically what happened is some of their mortgages were basically defaulted, and that defaulted a bunch of other mortgages, and it was just sort of a chain reaction. That's sort of what made them lose a ton of their value, because that's where the majority of banks make their money. That's sort of a miniature version of what happened during 2008. And yeah, also if you're not aware of what 2008 and 2001 is, basically there was a huge stock crash. There was a huge crash. The S&P 500 went down like 20% or something, 20-30%. I don't know, it went down heaps. I don't know the exact numbers, but yeah, I was just basically a young kid at this time. I barely knew what happened until like a few years ago, really. Wasn't too educated in it. But yeah, basically I think be cautious, put your money in things like he was saying, commodities, which is something I agree with, because it's very like you do it on like a weekly basis. But I don't do commodity investing. Maybe I should look into it, but I'm not sure, because a lot of it is just events trading. And then for value investing, if you'd like to look up some great books or read some great books, look at some great places, he told me a website after we were just chatting. He said Daily FX, which is Daily Forex, which is mainly where you can learn about commodity trading and foreign currency trading. So that's one thing. Another thing is you could look at Investopedia. That's got a lot of great things teaching you about all the basics. Another one is, this is where I first got the push and just the pat on the back to just start investing, is Woodysgamertag. He's an old gaming YouTuber who's sort of like a very fatherly figure to his followers, and he basically taught me to invest for the first time. He just went over compound interest, went over dollar cost averaging, which I still don't know much about, and I don't know. I don't think that's a very hard thing to do, but I think it's just not something I'm able to do because I don't have a way to set up an account with my investing with my broker that I don't have a way to set up an account with my broker that automatically does it without a fee or a yearly fee or something. I don't have a way to do that, so that's a bit of an issue. Another really safe thing to do, I think, if you don't want to see your money in 10 years, if you don't want to be able to take out your money in 10 years, if there's a crash and you might need it in 2 years, then don't put it in. Like if you might need this money in the future, then put it into somewhere that you know you can probably get it out. Like, since we are pretty close to having a crash, like the majority of people that know about this stuff know, like, we're probably about to have a crash. Like, my dad, he's a pretty good investor. He's made like 20% returns over the last whatever amount of years. And I know Gary Vaynerchuk, I think Tony Robbins is also, he wrote a book about it, but I think he said something about he's getting, like, the majority of good investors have a lot of their money out right now, like at least 50%, because you've got to realize the crash happens quite fast, and it'll be like a 20 or 30% crash, and then once you hit the bottom of that crash, which nobody knows when it'll be, because basically people aren't aware of this kind of thing. Basically, when it hits the bottom and you start investing, it goes up reasonably fast. Not as fast as it went down, but it's going to go up pretty fast. And you can make a lot of money just by investing at the end. Or what happened in 2008 is some guy, there's these things you can do. I don't know much about it. I just got taught about it recently. Is you can either short a stock or go long a stock. So if you short a stock, you're basically betting that it will fall. This happened with Herbalife and some other guy, and then some guy countered his thing. So if you short a stock, you're basically betting that it will go down. I'm not sure how to explain it. Basically, say your friend owns a stock, and then you borrow the stock off him for whatever price you borrowed the stock off him for, right? Basically, you short that stock, and then if the stock does go down, then you make a profit. But if the stock goes up, which it can infinitely go up, then you're fucked. So if you went long, if someone went long a stock and someone else went short a stock, and it went up, the person who went long wins, and if it went down, the person who went short wins. So yeah, that's another way that some guy in 2008, it's a movie, The Big Short, he basically talks about all of that. Like he knew all these mortgages were fucked, like they were all stupid, and he just could feel that it was going to crash very, very, very soon. And I don't know how he knew, but he knew, and he was right. So basically, he got as much money as he could. He got all his friends, he got everyone, he got out loans or something, I don't know. And he just went short so hard on all these stocks. And yeah, he made so much money. Like, in a way, you could say that it's bad, but in my opinion, I don't think, like, there's nothing you can do really. Yeah, another thing I think, because since you're probably a student, or you might be an old person listening to this, if so, hello, I am an 18-year-old. I hope you still heed my advice, as the things I'm talking about, I try not to give misinformation about, but like, I don't know too much about these things, but I'm just trying to teach and learn at the same time. So for students, I recommend index funds are a great way to do it, because it's reasonably safe, because as Alex was saying, it's diversified. It's not concentrated into one stock. An index fund is basically say 500 stocks for the S&P 500. It's the top 500 stocks. I think it's the top 500 performing stocks of the year or whatever in America. And yeah, it's very, very safe, because if one stock crashes to zero, that might be like 0.3% of the whole fund, and it goes down 0.3%. So yeah, there's not much danger with index funds. But if you do see a correction, it is going to go down a significant amount. That's just because every stock, like 99% of stocks, probably 99.9% of stocks are going down in a correction. So when I say correction, that means a crash. And a crash is basically, yeah, it's going to happen regardless. Like eventually there's going to be a correction, just because we can't have this infinite growth that is caused by inflation and just like, because it's sort of in a way everything's growing too fast and everything is so overvalued. That's the issue with buying stocks at a time like this. If you buy, say, if you love Apple and you want to buy so much fucking Apple, like for instance in the Auckland stock market, I don't really want to buy a stock that's hitting all-time highs. Like it could seem like a good idea, but really I buy, like for instance, Spark, which is previously Telecom. Back when it was Telecom, it was really high, and then it crashed all the way down to like a few cents. I don't know, it crashed really, really low. Just over time, it slowly went down, didn't crash. And now they changed their name to Spark. They did all this rebranding. They've completely changed their business, and everyone loves Spark now. Spark is killing the game. They just partnered with Netflix. They've done all this cool stuff. It's weird that they aren't really soaring right now, but one thing they are doing is in the last 2 years, it's a consistent like 30-degree upward slope. Like it's just completely going up. So yeah, like if you invested 2 years ago or whatever, then you're going to see good gains. But I don't know. The majority of stocks are overvalued right now. And that's one thing you sort of want to avoid. That's the general principle of value investing. As Warren Buffett said, it's better to buy a great company at a fair price than it is to buy a good company at a cheap price. So that basically means you want to buy companies when low, yes, but the main thing you want to do is buy a good company that in 10 years will be great. But so really, he's got all these 12 commandments. I might do an episode purely focusing on those, because I think there's so much value that can come out of that. And that sort of goes more the philosophy of stocks. But yeah, like I have a topic written down saying my philosophy, but in essence, I'm not a really experienced investor, but I've been learning quite a bit about it. And one thing that you should do, and that I should really do, is I should be setting up a demo account where it's basically you're playing with stocks. And the guy who's on this podcast, Alex, he did this, and he made like ridiculous returns the first year or two that he had his demo account, and then he got into the normal stock market. Then he was making good returns, but he wasn't making nearly as much, which is quite crazy. But yeah, one thing with stocks is emotions play a lot into it. So like even yesterday, I bought the stock and I was so confident about this stock, and then it went down like a minuscule amount. But I was like, oh my god, maybe this is a horrible decision. Maybe I should just sell now and eat the transaction cost. Like the transaction cost is a pretty tiny amount. Like I can make that in like a few hours. Like yeah, it's nothing major, but I was just thinking I should just eat that cost because I thought I made a horrible decision, because maybe there's going to be a crash tomorrow, blah blah blah, all these reasons. But like in the end, if I'm not going to need that money in 10 years, if I'm not going to need that money tomorrow, like you've got to have significant cash backups that you won't need that money. Because if it is down at that point and you're thinking of buying that thing, you're thinking of buying that stock, then really I don't think it's a good idea, because you're going to say if you invest $2,000 and then it goes down to, your investment goes down to like $1,500, and then you take it out, you've completely lost all that time that you had that in there. It was a complete waste of time. You lost money. Yeah, pretty much there's no way that benefited you at all, except teaching you a lesson if you heed the lesson. So yeah, the main things are, first, save your money, weekly increments, start small, start very, very small. If you say you cannot save money, then can you save $1 a day? If you literally can't save $1 a day, then start working more. Like, there's got to be something you can do. Start selling clothes, start doing the Gary Vee flip challenge. There's always something you can do. You can give yourself excuses about not being able to save, but you can save. It's just about self-discipline. That is the main thing with money. It's about self-discipline and just controlling your emotions. Like, have you ever bought a pair of shoes that you don't need and you say you can't save? Like, you can't be giving excuses. If you're buying coffee every day or even once a week, that's $5. $5, $4, whatever, it doesn't matter. But that amount of money can go into your savings account. If you're just about to buy a coffee, just stop yourself and then just put the coffee down and then just walk away from the store. Just walk away from the store. Yeah, so basically that's the ideas I have. Basically, if you're about to buy some food that you really don't need, that isn't going to provide you with nutritional value or keep you from getting hungry, then just walk away because you don't need it. If you're about to buy something that if you think about it, will you need it in a year? Don't buy it. Unless it's something you really need. Like, I'm not against buying things, because just for this podcast, I spent $300 on this microphone, and a while ago, I spent like over $2,000 on my laptop. Like, I'm definitely not against buying things that are tools and that are going to help you succeed in life, but obviously there's value in spending money on things you just like. Like, I've probably spent $60, $70 on movie tickets this year just because it's so easy for me to just walk into the city and go see a movie because I find it fun, and I waste 3 hours and it's all fun. It's just a little escapism. But yeah, I don't see an issue with buying nice things. But yeah, basically the first step is start saving. Just even start small. Eventually you'll be able to invest a reasonable amount, and then yeah. And yeah, I think that's it. Basically, start investing. If you don't, I don't know why you would not invest. It completely puzzles me why people don't invest their money. It's really, really easy. Like, there's so many things that I do that obviously it's my preference to do them because I enjoy doing most of them, but I just don't see how people are doing them because the value that you get in the long term is so much. Like reading books, like investing, like going to the gym, like just working hard in general. Like, I don't know. That's just my little thing, and I don't see how people can still give excuses, but I don't know. I think really everyone should be at the very least saving their money, like automatically saving $20 a week, because maybe you don't need that money now. Maybe you're a student who lives kind of comfortably. Like, some students don't live that comfortably, but some do. If you have a goodish job and you can just work away, get good grades that you need to get, and then save that money instead of spending $200 going out with your friends. Like, yeah, it's fun going out with your friends, but they're not all the nights are fun. Like, I think the nights are fun until they're not, and then you keep doing it and you keep doing it and you keep wasting that money. Say if you are spending even just $100 out a night, whatever, and then you save that money instead, in a year that's nearly over $5,000. Like, come on, just start saving. There's always something you can do. If you don't have the income to do it, then upgrade your income. There's a thing you can do that Gary Vee, I guess not invented, but he's doing, where it's called the 2017 Flip Challenge, where basically you buy an item, like you buy a fucking drink bottle, and then you try to sell it for a higher price on TradeMe or eBay or whatever. Yeah, basically, like, you can buy it at a garage sale or buy it at TradeMe, and yeah, so basically it's quite an easy thing to do. I don't see why you wouldn't do it. But yeah, because people will eventually buy your stuff, but you just had to put it at the right price. Like, if you bought it overpriced, then it's not going to sell, really, most likely. But yeah, there's always ways you can make more money. Just take another job or start doing freelance jobs, start doing freelance work. Say, College Info Geek recently did a podcast where they talked about all the freelance work you can do. There's so much. Like, personally, for myself now, I believe I could do freelance work doing podcast editing, making images on Photoshop for companies. My friend, I guess it's not really freelance work, but when he first started his company, Cora Media, he started just managing people's Facebook pages. Like, he would just call the company, tell them blah blah blah, I will manage your Facebook page, all that, and then a lot would say no, but then some would say yes, and then he would charge them a small amount, and he would just create their Facebook page and then manage it per month for a small fee. So that's a good amount of passive income that he's getting from creating a Facebook page, all that. So there's always more work that you could be doing to get that money and then get that income, and then you're gonna appreciate it in a year. Like, that's one of the main things that made me realize how important hard work for the long term is. Like, it just, you gain so much. I don't see any downsides really. There's a few downsides, like it's hard at the time. Maybe you limit yourself, but I don't know. There's not many downsides really. I can't see any significant downsides of saving your money and then investing it. Like, everyone wants to save their money, but they all give all these excuses, blah blah blah. But it's relatively easily, especially if you're a student that goes on holiday and you're working 5 days a week. Like, if you get a job when you're a student and you start working 5 days a week, then you can do it. Because I think working 5-6 days a week as a student, you earn something like $500-$600 a week from getting like a normal job, like a normal person job. I don't know. I've never got one, but yeah, basically, even if you're working for myself, when I'm working 3 days a week or 2 days a week or whatever, and you just take that money, save half of it, invest the rest. Like, I mean, you save half of it, spend the other half, and just cut down on things. Just learn how to save. Like, say if you're gonna, like for myself, one thing that I could do is stop buying so much Gymshark. But in a way, I don't see that as such a waste of money, because I'll use it in a year. I'll use it in probably 5 years. And yeah, but just try to evaluate what you're buying when you're buying it. Like, I was, like, when the new iPhone's coming out, I'll probably be very, very tempted to buy a new phone just because my front camera is cracked and it doesn't really work properly on my iPhone 6s. So it's like I'm upgrading like 1.5 generations, so I don't think it's particularly worth it yet. Like, once my iPhone gets slow as fuck, then I believe it's a good time to upgrade. But like, when it comes to value that my iPhone brings me, I don't think I'm going to gain much. Like, I'd probably only gain, if I had to put a number on it, like $200 of value from getting the new iPhone. It would surely be very, very, very enjoyable for me to get that new iPhone. Like, I was also thinking about buying an iPad. Like, I was thinking, wow, wouldn't it be amazing if I just bought that iPad and then I could just play with that all day? But no, like, I think it's just stupid, to be honest. But yeah, so I think I'll probably cap it off here. That's basically a lot of my opinions and a lot of my thoughts on saving, investing, and just getting productive, really. So yeah, thank you guys very much for listening. Have a good night. I would love if you would check me out on Instagram and Facebook at WonkyWalshami. Check out my blog at walshami.com. And I would love if you would also subscribe to the podcast or leave me a review. It means so much to me, and I really want some negative or constructive feedback about this podcast. So yeah, thank you guys so much for listening, and have a good night.